Hi, this module is about cash and accounts receivable. Your homework focuses in on accounts receivable, but let's talk a little bit about cash. Cash is considered a current asset, and you'll remember that a current asset is any asset that is intended to be converted into cash within a year or the company's operating cycle, whichever is longer. Included with cash as a current asset are marketable securities. Those are securities like stocks that you buy and you sell on a daily basis, like you're a day trader because you're trying to manage your cash. You have some extra cash and you're looking to do better than making interest on your checking account or your savings account. Accounts receivable, that's where customers owe you for a sale that you have made to them. Inventory, which are products or goods that you have either acquired or made that you've offered to customers to buy. Supplies, which are internally used items, and prepaids, like prepaid insurance, prepaid rent, where you've paid for something in before you've used it. Now, let's talk about the operating cycle. The operating cycle is sometimes known as cash to cash because it's how many days is your cash tied up in non-cash resources that you engage in because you're in business. So you have cash and you go out and you either manufacture or you purchase inventory, which you put price tags on and say customers come in and buy from us. But the trouble with having customers buy from you, many times instead of receiving cash from those customers in a cash sale, you say, I'll bill you. And so we have accounts receivable. So your cash is tied up waiting for your customers to pay. So the cash to cash cycle, which defines what a current asset is how long does it take for that cash to cycle through being products or the production of services into promises by your customers that they'll repay you. The shorter that operating cycle is, the more efficient that business is in its ability to generate cash or to utilize its cash in the most effective way. Now, when we have cash, we have to think about how we control it. And we'll want to control it physically, meaning we keep it in the bank or we keep it locked up in a drawer at work, and we want to control it by our record keeping. So we'll have documents such as a deposit slip or a sales invoice or a check or a bank statement or a bank reconciliation where we're trying to track our cash, and those are effective ways of doing it. Also, if you have cash and you borrow cash, generally speaking, whoever you borrow from is very interested in whether you can repay. So they'll put restrictions on your cash through the means of a loan or a debt covenant, which says you have to follow these rules as long as you have borrowed this money from us. And generally it says that you have to keep certain compensating balances or a certain percentage of the loan in your checking account or your savings account at the bank as long as you have that loan. And those are restrictions placed upon you as a creditor to ensure that the future payments of both principal and interest can be made. Let's now turn to accounts receivable.